Finally, someone said it. And they know what they're talking about.
Markets are hitting new record highs. My next guest says the Fed's 2% inflation goal won't be met without an extended period of subpar growth. And he's noticing an odd divergence between the performance of large small stocks and quality to junk bonds. And he says it could be a major warning sign. Joining me to explain is Richard Bernstein. He's CEO and Chief Investment Officer of Richard Bernstein Advisors. It's great to have you here. And is this a change in tune, Richard? Normally when we talk, you sort of reassure me that everything's going to be all right.
Right. Well, Kelly, I think the question is not whether one's bullish or bearish. I think it's bullish or bearish on what. And, we're basically very cautious on 7 names, the 7 names that everybody knows, the 7 names that are distorting all the indices, as you just pointed out. But realistically, we're pretty bullish on everything else in the world. And I think that's really the dichotomy. I think everybody knows we have a bifurcated market. It's hard to believe that the opportunities outside of maybe the next 10 minutes are in that group of 7 companies, right? Everybody knows about them. They're flush with capital. There's no surprises. But yet the other side of that seesaw, if you will, is historically broad and historically undervalued, and their fundamentals are improving, and nobody cares.
So I'm so glad I'm just so glad we're having this discussion. Okay, so some might say, and if you look at the first quarter, David Kostin highlighted over the weekend as well, the big 5 earnings growth, exclude Apple, their earnings growth was 84% year on year in Q1. The rest, the median S&P 500 earnings growth was 5%. Which would you rather own? I want the 84%. So it's interesting to hear you say, listen, the leadership is too narrow and you should look to everything else. And I'm thinking, I think everything else looks pretty bad right now. And I'd rather stick with what is showing this phenomenal growth.
Exactly. I mean, that's what the common thought is, that we want these fast growers. But the reality is, if you look at analyst forecasts, those growth rates in the Magnificent 5 or 7 or 2, or whatever you want to call them, are supposed to slow pretty dramatically as you go through the year. Meanwhile, if you look at small cap earnings expectations or emerging market earnings expectations, by the end of this year, both small caps and emerging markets are forecasted to grow faster than the Magnificent 7 earnings growth. So it's a matter of relative earnings here.
You really think
it's actually true.
So,
yeah. I mean, if nothing else, we have to remember that some of these companies are much more cyclical than people think. I don't want to point out individual names. They are experiencing tremendous cyclical surges here. But the difference is, normally when cyclical stocks have a big cyclical earnings surge, multiples compress. This is very unusual in that we're seeing this big cyclical surge and multiples are expanding. That really should be a warning sign to a lot of people about the sustainability of this growth. Look, Kelly, the way I would describe it is, we all know that a Maserati is a great car, right? And if I tried to sell you a Maserati for a Volkswagen price, you'd buy it in a second. You'd ask me for 2 or 3 of them. But if I tried to sell you a Maserati for $2.5 or $3 million, you'd say I was nutty. How come people understand that when it comes to cars or any economic transaction? You go to the stock market, and all of a sudden the Maseratis are worth $1 bazillion.
Let me put it a different way. And I drive a Honda and a Subaru, sedan. So I'm with you, believe me. But
I don't drive a Maserati either.
To put it this way, if I were to say, I'm actually quite concerned about some of the larger signals we're getting on economic growth. You talked about this: unemployment rates rising, the consumer's clearly starting to become a little tapped out, et cetera. The only thing I might feel comfortable owning in this market is the kind of stuff that's less exposed to that and is more exposed to the AI complete revolution that we have to build out. I would much rather be in those stocks. Why do I want to be in McDonald's or Starbucks or, anything that would possibly face this couple percentage point erosion at the margin we could be heading into? I want to be over in data center and cloud, whatever it is that's going to support this new build out. So it feels ironic to say that I would be more comfortable with the far overextended trades than I would be with everything else right now.
So Kelly, that's kind of like what people were arguing during the tech bubble, that there was going to be the build out of the internet, there was going to be the build out of fiber optics, and that was the place to be. They were right. There was a build out of the internet, there was the build out of fiber optics, but because the stocks were so expensive, there was little room for disappointment. And what happened was,
as you know, this is 84% earnings growth in the first quarter. These are stocks trading at 30 or 40 times forward. This is not pets.com.
Well, Kelly, I hate to say this.
Go
It's a little
for
bit
it.
selective memory there. It's a little bit selective memory.
I have no
There
real
were some
memory there.
real-
Go.
Yeah, there were real companies in the tech bubble with real cash flow, real balance sheets. And if you bought those real substantial companies that now like nobody would care about, like IBM, right? That was a big substantial company back then. Cisco, right? Not SYY, SCSCO, right? These were real companies with real cash flow and real balance sheets. And what happened is if you bought them at the peak of the bubble, it took you between 5 and 20 years just to break even.
To be honest, I really don't know how to start this video. Besides, I am deeply concerned. More concerned than I have been in a very, very long time. Like probably January, February of 2020 when all of the outbreaks started over in China, and it seemed like there was a decent probability that would come to the US and wreak havoc. Indeed, that did happen. It came about a month later. I am equally as concerned now as I was then. And I actually might be a little bit more concerned now than then, to be honest with you. Nvidia has officially become the most valuable publicly traded company in the entire world. Nvidia has now become the most valuable publicly traded company in the entire world, beating out Microsoft today by about $5 billion. Now here on this channel, we've talked about the discrepancies between your average S&P 500 companies and Nvidia. It's obvious. Average companies in the S&P 500 have not done anything but decline in 2024, and Nvidia has went straight up. This really looks like a bubble, at least in the short term. It seems like expectations are far too elevated. Isn't this ominous? B of A, in their June fund manager survey, says, quote, most bullish since November of 2021, driven by cash levels at 3-year lows and big equity allocations. As a couple individuals point out in the comment section, 2022 turned out to be a real dinger, and November of 2021 was a top. If that's not ominous, I don't know what else is. And as the economy weakens, like we got today with retail sales, I'll share that in just a moment, companies will slow down their investments in Nvidia chips. As of early April, there was only a 2 to 3 month wait time for Nvidia's H100s. That's still elevated. You still have to wait a couple of months, at least last we knew. But as the wait time comes down, the pricing on chips will fall. Kind of like a TV that used to sell for $15,000 or $20,000 that now sells for on average like $400. And H100s are only supposed to be sold, they are manufacturer's suggested retail price, MSRP, at about $7,000 to $8,000. They're going for much more than that because demand has been so strong. And don't get me wrong, I think Nvidia is the future. I do. But I think that future is balled up into expectations that are far too dramatic in the near term. And why is that? Well, semiconductors by nature are cyclical. Who is buying semiconductors like Nvidia's H100s? For the most part, it's your big tech companies. Well, what are big tech companies going to do as it looks like the economy is slowing down, the Fed is going to make an error, and we're going to go into a recession? What are they going to do? They're going to stop ordering as many Nvidia chips. They're losing a hell of a lot of money on the chips and on the software that they're trying to develop using the chips for different AI, endeavors. So AI right now is all around a money-losing business. That's fine when times are good, but when times are not so good, that's the first thing that gets cut. And after all, if you're Microsoft, Meta, Tesla, Apple, doesn't matter, any of your big tech companies that are the ones buying all the Nvidia chips, they already have enough of them. So not only will you inevitably see demand slow down, but pricing will also come down as well. With Nvidia expected to grow at double-digit rates year after year after year after year, it's hard to make sense of current valuations. Now, this is one part of why I'm so concerned right now, but it's not just Nvidia or AI. It's also the Fed. The Fed made it very clear they are going to push the economy into a recession before they start cutting rates. And as I have said here on this channel, I think the markets have priced that in certain areas. For an example, small cap stocks are trading much closer to a recessionary-like multiple. Medium cap names, average stocks are trading at a discount to historical multiples as well. Big tech is not. And it really comes down to AI and this perceived safety that all of a sudden big tech companies are no longer cyclical to the economy. And for anyone that does not know, cyclical just means they move in line with the cyclical cycles of the economy. Meaning if times are great, then cyclical companies are going to do great, right? If times are bad, well, cyclical companies are going to do bad, is basically the easiest way to put it. So I really think this is a bubble of false expectations. The expectation that Nvidia will continue to beat and continue to beat and continue to beat, and that's the only area that you can invest your capital because of recession fears and Nvidia is immune. None of that is true. Eventually, Nvidia will miss on earnings, will guide lower, the economy will go into recession, and AI will be put on the back burner. Again, AI is a multi-decade theme, but the next 1 to 2 years, it's just a money-losing endeavor that only works when times are good. Now, given all of this, markets are severely overextended with the discrepancies under the surface, as you heard in that clip, of big tech just soaring markets higher and everything else going lower. I just don't know how much longer that markets can hold up like this. And I know a lot of hedge funds, institutions, money managers that you'll hear on CNBC, Yahoo, Fox Business, wherever it is, they're going to say a broadening out of this market is coming. Because that is literally the only justification to think stocks are going higher from here, is you have to see a broadening out of our markets. Earnings expectations are at the highest they've been in multiple years, not just for 2024, but also 2025. So you're not only betting on no recession, you're also betting on companies that continue to perform. Which is that possible? Of course. I think the risk is dramatically higher now that the Fed made it clear we're going into recession before they start to materially cut rates than the markets want to realize. And I do think there is some dislocation in exactly that. And to mark my words, I am not a financial advisor. I am not a financial planner. I don't have a crystal ball necessarily. But when I make videos like these, I tend to be correct. I tend to be early most of the time, like 95% of the time. But I won't be wrong on this. I will be right on all of this. I know to some of you guys that haven't watched this channel for a long time, that might sound arrogant, that might sound like, I know everything, and that's not the case. And the fact that I am an uber bull on AI and I'm saying this just kind of puts that into a little bit more perspective. And if you really want to boil it all down, I don't think AI is necessarily the problem, because AI will do okay until companies feel like they need to pull back their investments, which is going to happen when the economy gets worse because of the Fed. So ultimately, this is the Fed that will cause the short-term downward spiral of AI, of our markets in general. As Bespoke writes on X, just to cut Nvidia in half from here would only take it back to the level it was at in early February. Consumers are now out of excess savings, hitting the lowest level in 5 years, according to Game of Trades on X. This could get ugly. Nvidia's CEO Jensen Huang just sold $31.2 million worth of Nvidia shares, following many other high-level executives that have sold a lot more than that of Nvidia in the past several weeks. The S&P 500 tech sector's price-to-sales ratio is going vertical and is now at a new all-time high. So for people that say the dot-com bubble was so much different than today, not on a price-to-sales basis. In fact, on a price-to-sales basis, It's much worse. Ryan Dietrich on X says, can this rally continue? Be aware that July has been up 9 years in a row for the S&P 500. Over the past decade, you're higher 90% of the time, tied with November for the best, and up 3.1% on average. He also says that June usually isn't very strong for stocks, but that's not working this year as we expected. Still be aware that from now until later in this month is one of the seasonally worst times of any year. BMO said today U.S. retail sales are visibly downshafting, with today's report, along with softening labor market indicators, adds to the evidence that should continue to put downward pressure on consumer price inflation and keep the door open for a September Fed rate cut. The markets are actually pricing in the first cut coming September 18th, 2024, with current odds of 61.1%. in favor of a cut, 32.3% in favor of a continued pause, and 6.6% chance of 2 cuts by September. So that would be a cut July 31st and in September. Currently, there is an 89.7% chance of no cut, no hike coming July 31st, just a continued pause, and a 10.3% chance of a cut. Even Tom Lee recently suggested that the Fed is going to be late by a couple months to cut rates. So it's not just me saying the Fed is going to cause a recession. Literally, Tom Lee is saying the Fed's gonna cause some economic pain. And economic pain caused by the Fed tends to lead to the Fed cutting rates, which leads to an over 20% drop historically in the S&P 500. At the first Fed rate cut. Retail sales month over month on the headline were revised down last month from 0% to negative 0.2%. This month came in at 0.1%. We were expecting 0.2%. So that was a worse number for last month. That was a worse than expected number for this month. If you exclude gas and autos, well, it looks even worse. Last month was revised from negative 0.1% to negative 0.3%, and this month's number came in line with estimates at 0.1%. Retail sales year over year missed estimates by a long shot. We were expecting 2.8%. We came in at 2.3%. Last month was also revised from 3% down to 2.7%. As Charlie says over here on X, retail sales increased 2% over the last year, but after adjusting for higher prices, they were down 1.2%. Both of these numbers came in well below the historical averages of positive 4.6% nominal and 2.0% real. The US consumer appears to be pulling back. Bespoke writes on X, here's the 5 mega caps with 500 billion of market cap value that are in extreme overbought territory, 2 standard deviations above the 50-day moving average. You have Broadcom, Microsoft, Apple, Eli Lilly, and Nvidia. Now that's extreme overbought. Just overbought would be Meta, Google, and Tesla. Game of Trades post on X to caution that job openings have been falling off of a cliff. Such sharp declines have only occurred 3 times since 2000, the dot-com bubble, financial crisis, and the pandemic. Each of them ended with a sharp economic downturn. They say the worst part, this is happening when the consumer has already run out of excess savings. So again, to think we avoid a recession here, the Fed is going to cut rates soon enough. Maybe Wall Street will tell you that, but I'm not going to lie to you. That's an outright lie. The question is, recession this year or recession next year? The other question is, does Nvidia's demand slow down this year? Does it slow down next year? Either way, the markets are not priced for either of those scenarios, economically speaking, or Nvidia's demand slowing down. And it's even more worrisome that you are continuing to see institutions capitulate to the bulls. Goldman Sachs writes today, quote, we think this year has 1995 flavor to it. 1995 was the last soft landing. The Fed cut from 600 basis points to 525 basis points. The SPX made 77 all-time highs, and that was just the appetizer with an epic run through 1999. Year to date, SPX already has 29 all-time high closes and the best start to an election year ever. This, my friends, is time to be extremely cautious. After all, fund managers are as bullish now as they were in November of 2021. Let's not forget that. It just feels like everyone is blind to all of the risks. I mean, certain parts of the markets are priced for them, but the most important parts of the markets are not. And it's just this all-in mentality. And that's fine. But when you have everyone going all in, everyone's super bullish, it really skews the narratives. Just like during a downturn, a crash in the markets, everyone's bearish because that's the popular thing, because that's the foresight that we are in. And now that's just shifted and we've lost touch of reality of the situation. The reality of the situation is this: the economy is slowing, the Fed's going to be late, AI is a real thing. It's here to stay. Investments will continue to flow into AI. But AI is, or semiconductors are, a cyclical business in nature. Companies that are buying these Nvidia GPUs, one, they already have enough to fund their money-losing AI adventures. They don't need to go out and continue to buy more and more and more and more. And when the economy gets worse and people stop buying as much Meta ads, or people stop subscribing to Apple or Microsoft's cloud services, then you will see investments into GPUs slow down, and that will happen. You're also starting to get to the law of large numbers, where Nvidia's growth rate is expected to slow down throughout the rest of this year and into 2025. That is still with Nvidia growing their overall revenue quarter after quarter after quarter after quarter. God forbid you were to see a down quarter there. That would be the easiest 20% down in the NASDAQ in our entire lives. Again, I want to be very clear. I don't know the timing of this calamity, this crash, whatever you want to call it, but I do know it's coming, and I do know it's going to catch literally everyone off guard. I feel like I'm standing in the desert with a bunch of people at an oasis, a little water, outing in the desert. And everyone's like, where's the water? Where's the water? And it's right in front of you, and just nobody can see it because they're so thirsty and deluded and delusional. And again, I have exposure to Nvidia. I am exposed to AI. I am fully invested in this market. I have absolutely no reason in hell to say this. It's not popular right now to call out the BS. But by nature, that's what I do. I'm not the guy that follows the bandwagon until things go south and then start reporting on the things that went south. I like to give you guys the heads up perspective to say, maybe things are not as great as we think. Because I think that is what is truly valuable. Who cares if you can report on good things or bad things that happen in the markets after the fact? Nobody was able to benefit from it. So I just want to be clear, is this time to go all in on cash? No, I'm not. I'm fully invested in this market. Is this time to go all in on puts? No, it's not. Do you want a little downside put protection? If you want, I have some puts that expire towards the end of August after Nvidia's next quarter earnings. But it's not a large position, and I'm prepared for them to go to zero because I'm fully invested in this market. And one of two things happens from here. Either you see a catch down in big tech and AI that comes down, matches the rest of the markets at a much lower level, or you get a catch up and the rest of the markets catch up to big tech and we continue on to hit new all-time highs. Either way, I'm comfortable here having a little bit more cash than normal, about 23% cash or so. And I'm comfortable being all in this market with a couple little hedges. So let me know what you think about this information down below in the comment section. So that is going to do it for this video. If you made it to the end of this video, you like my perspective, whether you agree with it or not, but you just like someone that can be unbiased and give you perspective on our markets. There's a lot of noise. There's a lot of noise that goes on in our markets, good and bad, feelings fluctuate on a day-by-day basis. This is raw perspective of what's actually happening, what is going to happen. Timing, can't tell you that. I'm not a financial advisor. I can't tell you what to do. I'm telling you what I'm doing. And I did here in this video. If you like that kind of perspective, continue to watch these videos and consider sticking around for a long time. You guys have a great rest of your day, and I will see you in the next one.